Right now in April 2020, gold has been one of the year's top performing asset classes, but with widespread selling in Asia and the market attaining new highs in just about every currency, should we still be buying physical gold? Today we explore the economic fundamentals in detail, so let's dive on in. Right here we've got our 4 key steps that we're going to run through as we actually investigate this marketplace. Now usually if you see a market which is attaining new highs and vendor premiums are rising while stock levels plummet, I'd say you're too late to the party. But the market fundamentals in favour of gold right now are so very strong. Just consider the zero interest rate policy and the prospect of widespread negative rates together with the potential for further market crashes as firms fail to actually meet their long-term debt obligations and insolvencies pile up. Then there's the sheer extent of the quantitative easing program, which is now beyond just credit inflation, that is backing up commercial bank reserves and thereby supporting asset prices. Now we're seeing out and out currency debasement through debt monetization. Irrespective of whatever the Fed's bullard claims, saying the aggressive programs enacted by the US Federal Reserve so far are standard and don't cross the line. In fact, 59% of the US's forecasted $3.6 trillion deficit will be financed through direct monetization alone. In fact, now we have the potential for 3 crises at the same time. First being the health crisis, then there's the oil crisis, and finally there's the prospect of a Eurozone banking crisis, which we'll look at in an upcoming video. An excellent measure we can use right now to actually understand the market uncertainties is through the copper-gold ratio. This ratio measures copper to gold and how much of an ounce of gold it takes to buy an ounce of copper. Given copper is an industrial metal, it's a proxy of confidence in the global economy, while gold as a safe haven measure is the exact opposite. This copper-gold ratio clearly shows market uncertainty, fear, and meanwhile it also reiterates the point that the stock market is so very disconnected from reality. So no doubt about it, the fundamentals support long-term price growth of gold, and I don't know any serious investor or economist who is not bullish on gold over the next 2 to 5 years. But investors' key concern with gold right now is whether there will be further price drawdowns, similar to those hefty blows we saw in late February and early March when the price fell as low as $14.50. This everything bubble is yet to actually burst, and gold investors are clearly aware of the risks of a deflationary debt bubble collapsing. Gold is effectively the anti-dollar, of course, so we must examine the relative strength of the world's global reserve currency to really inform our decisions on gold. To date, the Fed's interventions has helped to actually reduce the value of the dollar, or the kurgan as we previously referred to it, and this has been good for the price of gold, that is McLeod, in recent weeks. With inflation yet to emerge, it effectively unties the hands of the Fed to actually intervene further in their QE Unlimited program, and again this really is good for gold. So I think we're likely to see one of 2 different scenarios play out here. The first is good for gold in the short and the long run. The second, not so good for gold in the short run, but good in the long term. So let's now take a look at scenario 1, which I liken to a sort of snowball effect coming down a mountainside, quickly gaining speed and momentum and size. Here we'll see further market declines as company earnings reports reflect the actual gravity of this situation. Declining earnings, deflation and debt is a recipe for a crisis. But this is different from the shorter term panic liquidity crisis that we saw in February and March, and it reflects firms' growing inability to actually service their longer term debt obligations. Rising unemployment and falling consumer demand are likely to compound this situation, and our snowball collapse leads to further slower, more gradual market downturns, which ultimately reflect an insolvency crisis. Therefore, this model really suggests that this is an opportunity to actually buy, but of course it's really important to bear in mind that we are not going to get a truly smooth path on the ride up. However, the second scenario is based upon an avalanche where everything collapses. It's a debt deflationary bust which could well see enormous enormous stock market plunges, which would impact all asset classes and perhaps see the price of gold dropping 25% or so. The Fed's money printing would go into overdrive and we'd quickly see double digits on their balance sheet. If inflation expectations haven't picked up by then, the Fed's balance sheet may well rise to possibly even the mid-teens. Remember, they've already explained that QE Unlimited will be used, and the only restraint on this policy is actually inflation. So if inflation remains low or negative, they will be throwing the kitchen sink and then some at this. But I think the deeper question by then will be, what level is gold actually at then? With such favourable market fundamentals, the price seems likely to trend upwards despite the summer months being quieter usually for gold. Will it be able to attain new dollar denominated highs and push on towards $2,000? Certainly seems possible, but a crash may retest some of the key resistance around that 1500, 1450 range. But this could just be the paper price of gold rather than the physical price of gold. And of course, we've seen a huge disconnect in the prices that you can actually buy physical for against paper gold. So should you be buying physical gold right now? It depends. It depends upon your current exposure level. If you already have a significant physical gold holding, you may want to actually look at highly liquid options through gold miners or mining into ETFs such as GDX or GDXJ for juniors. Alternatively, you may wish to actually add diversification to your portfolio and look at other asset classes. We've already seen a number of firms have benefited substantially from this lockdown scenario. What happens if we face a second wave of this virus or this lockdown persists further? Holding some cash provides optionality and helps you to actually switch strategy and pick up bargains if and when they actually arise. I believe everyone should have a percentage of their portfolio allocated to gold, be that anywhere between 5 and 20% or so, but you may wish to actually balance any further purchases out between now and the autumn. This is when I'm expecting the real flood of bankruptcies to actually occur, as we suddenly appreciate there has been a complete collapse in consumer demand. But the final point to bear in mind here is your time preference. Holding physical gold is not a short-term strategy. I like to back clear trends. If you're prepared to buy gold and ignore short-term price fluctuations, it really looks like a winner. Consider that in the noughties, gold rose 280%, but gained just 35% across the 2010s. The gold price moves in a cyclical nature, responding to crises, fear and uncertainties. And so what about central banks? Well, Russia, as Jim Rickards has said here, after announcing that they would stop buying gold, the Russians went out and bought gold. Those rascals. Russia bought 9.33 tons in March, bringing Russia's total gold reserves to 2,299 tons. Makes the oil price fiasco a bit easier to take. Meanwhile, the annual global gold discoveries has fallen precipitously, as we can see here. So it really does suggest that there is enormous potential for the upside on gold. Now, in saying all of this, I'm reminded of Aldo Gucci's quote that quality is remembered long after the price is forgotten, and gold's historical quality as a long-term store of value is almost without precedent. But I'm afraid there's no hard and fast answers in the macro world, just clear trends to actually provide key insights for those who actually like to think long-term. Now, if you want to know why the Fed will need $10,000 gold, just check out this video here. Or alternatively, if you want to know why the gold price has such a large potential upside, do check out this video. Thanks for joining me. Make sure you've hit that like button, and I look forward to seeing you next time. Bye bye.